You open your brokerage app and your heart does a little jump. The number next to your stock is green, and it's higher than it was yesterday. Or maybe your stomach sinks because it's red, and it's lower. We've all been there. But in that moment of emotion, have you ever stopped to ask a more fundamental question? What is actually happening when that number changes? What does that green or red flicker on your screen truly represent in the real world? It's easy to see it as a simple scoreboard, a game you're either winning or losing. But the reality is far more fascinating. A stock price is not just a number, it's a living, breathing consensus. It's a story being written in real time by millions of people about what they believe a company is worth, not just today, but far into the future. Today, we're pulling back the curtain on the greatest auction in human history. We're going to explain, in simple terms, what is physically happening when a stock price moves, what it means for you as a shareholder, and what it means for the company itself. Let's start with the most basic mechanics. The stock market is, at its core, a giant, continuous auction. On one side, you have people who want to sell their shares. On the other side, you have people who want to buy shares. The price you see on your screen, at any given millisecond, is the price at which the last trade was executed. It's the price at which a willing buyer and a willing seller agreed to make an exchange. So, when a stock price goes up, what has happened? It means that the last trade occurred at a higher price than the trade before it. And why did that happen? Because a buyer was willing to pay more to acquire the stock. This almost always means there were more buyers, or more aggressive buyers, than sellers at that moment. The buyers had to bid up the price to convince sellers to part with their shares. Conversely, when a stock price goes down, it means the last trade happened at a lower price. Sellers were more motivated to sell than buyers were to buy. They had to offer down the price to attract a buyer. This is the pure, unadulterated force of supply and demand in action. It's no different from a bidding war on a rare collectible on eBay, just happening millions of times per second across millions of different items. Now, this leads to the million-dollar question: what makes those buyers and sellers change their minds? What causes this constant tug-of-war? The answers fall into two main categories: company-specific factors and market-wide factors. Company-specific factors are all about the health and prospects of the business itself. A great earnings report that beats expectations tells investors the company is more profitable than they thought, so they value it more highly, and the price tends to rise. The announcement of a revolutionary new product can cause a surge of optimism, driving the price up. Conversely, a product recall, a data breach, or a disappointing sales forecast can shatter confidence, leading to a wave of selling that drives the price down. It's the market constantly re-rating the company's future potential. But it's not just about the company. Market-wide factors play a huge role. This is where things get psychological. If the Federal Reserve raises interest rates, it can make bonds and savings accounts more attractive, pulling money out of the stock market and causing broad price declines, a bear market. If there's political instability or recession fear, a wave of pessimism can cause investors to sell everything, even stocks of great companies. This is a critical concept to grasp in the short term. Stock prices are driven as much by emotion, sentiment, and macroeconomic news as they are by a company's actual performance. A fantastic company can see its stock price fall in a bad market, and a mediocre company can see its price rise in a euphoric bull market. The stock price is a voting machine in the short term, but it's a weighing machine in the long term. So, what does this moving price mean for you, the individual shareholder? This is where we need to clarify a crucial point. When the price of a stock you own goes up, you have what is called an unrealized gain or a paper gain. When it goes down, you have an unrealized loss or a paper loss. These gains and losses are not real until you actually sell the stock and lock them in. It's the difference between the value of your house going up on Zillow and actually selling the house for cash. That paper profit feels good, and that paper loss feels bad, but your actual financial situation hasn't changed until you execute a transaction. This is a foundational mindset for successful long-term investing. You have to learn to be somewhat indifferent to these daily paper fluctuations. If you did your research and bought a great company, a temporary drop in its stock price is often just noise, not a signal that you made a mistake. It might even be an opportunity to buy more at a lower price. The goal is not to profit from every little zig and zag, but to see your investment grow substantially over many years as the underlying company becomes more valuable. Now, what does a moving stock price mean for the company itself? This is a common point of confusion. For the vast majority of day-to-day trading, the company whose stock is being traded is a spectator. If you buy a share of Apple from another investor on the Nasdaq, Apple the corporation does not receive that money. The cash goes to the person who sold you the share. However, the stock price is incredibly important to the company for three key reasons. The first is market capitalization, or market cap. This is the total value of the company, calculated as stock price multiplied by total number of shares. A rising stock price increases the company's market cap, making it more valuable on paper. This is crucial for its reputation and clout. The second reason is acquisitions. A company with a high stock price can use its own shares as currency to buy other companies. It's much cheaper to buy a competitor when your stock is highly valued. The third and most direct reason is future fundraising. If a company wants to raise money by issuing new shares in a secondary offering, a higher stock price means it can raise more money by selling fewer shares, which is better for existing shareholders. So, while the company doesn't get the cash from your everyday trade, its stock price is a vital barometer of its health and a key tool for its future growth. Before we finish, it's essential to ground this in a responsible perspective. The constant movement of stock prices can be hypnotic and can trigger emotional, impulsive decisions. Seeing a stock shoot up 20% in a day might make you feel like a genius and tempt you to buy more at the peak. Seeing it crash 20% might terrify you into selling at the bottom. This buy high, sell low behavior is the most common way investors destroy wealth. Understanding that prices are driven by a volatile mix of logic and emotion should give you the clarity to stay disciplined. Focus on the value of the business, not the ticker price. A great company is still a great company even if its stock is having a bad week. The most successful investors are not those who predict every price swing, but those who find high-quality assets and have the patience to hold them through the inevitable volatility. So, to recap the entire story. When a stock price moves, it represents the last agreed-upon price between a buyer and a seller in a massive, global auction. It moves due to a constant reassessment of a company's future, influenced by its own news and the mood of the entire market. For you, the shareholder, it creates paper gains and losses that only become real when you sell. For the company, it determines its market value and its ability to grow strategically. The next time you see that number flicker on your screen, I hope you see more than just green or red. I hope you see the incredible, dynamic, and sometimes irrational process of collective valuation in action. Now, I'm curious, what was the biggest aha moment for you in understanding stock prices? Let me know in the comments. Thanks for watching, and I'll see you in the next one.